Hello friends and welcome to my YouTube channel Simply Stocks, and today I'm going to talk about JK Tire. Should you buy the stock at current levels and hold it, or you should avoid it? So let's understand this. Let's get started. First of all, a disclaimer that this is not a stock recommendation and people taking any position to any share that I talk about should do this with their own due diligence and research, and I'm not in favor or against any company that I talk about. Before I talk about Jacket, I have a small request that kindly support me on Patreon, and once you do that, it will help me grow the channel, help you also ask me questions in greater detail. Once you get the $10 membership, you'll have access to my portfolio, my watch list, and number of podcasts that I put up from day to day. For detailed market or company talk, you can directly contact me on email and we can have one-on-one discussion. Now about the company, JK Tyre was established in 1951 and one of the biggest tire manufacturers for passenger as well as commercial vehicles and two-wheelers. The market cap of the company is around 2000 crores and has export operations to multiple locations globally. If you look at the financials, then these are Q2 numbers FY21. So these are just nearby September numbers. The December numbers are not out yet, obviously. 6% growth in sales, but the profit dipped by around 33%, but yet it remained solid at 108 crores. So you need to understand that auto ancillary and autos are coming back after a 3 years of total you can say disintegration in its industry, especially through the shutdown. The industry did not do that well, and that is being shown on these numbers. So at least they have come out with profitability and solid profitability, and that is a positive. Tax write back last year swelled in a number, so you need to understand. So 168 crores was due to write back of tax of around 100 crores or so, 80-90 crores. So minus that, profit would have been in range of 75-80 crores, as I said, for FY you can say 20. So say if it was 80 crores and has gone up to 108 crores, that is just a 30% growth rather than a 33% degrowth. So you need to understand that in fact exactly it is a 35% growth rather than a 33% degrowth. A decent promoter and institutional holding is there, and ratios are low. I won't say return ratios are very good, but they are decent enough at high, at you can say low double digit, at around 10 to 11%. Now we look at the stock performance. So it has been falling relentlessly from 2018 Jan. So we have had a fall, and it fell around 60% in that February and March fall, and went to really abysmal levels of around you can say 35, 38. Have doubled from those levels, and we have seen the stock surge to 80 levels, 80, 81. Numbers are strong on the bottom line, as we have seen the September numbers, and which is a highly positive thing. And I think this is a turnaround in the industry that is taking place only now. So this may just continue for the next 2 3 years to come. Return ratios are average, and prospects look bright for the industry. So it looks like, as I mentioned, that next 2 to 3 years could be extremely good. And I have been mentioning this, that auto ancillary may just end up performing, and autos as a whole, in the next couple of years, 21 and 22. And I told this in 2019 as well, that probably 1 year of hiatus will be there, 1 year of real trouble could be there for the autos, but then things will improve, and this looks like a turnaround story for the whole industry. So prospects really look bright for the industry in the coming couple of years. If we look at the industry as a whole, stable crude prices will aid numbers, although crude prices has surged a little bit. So they have gone to 50 $52 per barrel. Maybe it may go to $60 per barrel as economies open up. But even in that sense, the stock will benefit because of the higher usage, as economies open up, offices open up, then there will be more usage of the vehicles, and hence wearing of tires and wear tear of tires would lead to replacement of tires or new cars being bought, etc. So that all leads to higher sales for tire companies. So economic recovery is a big you can say positive for this industry, and valuations in my opinion is a bit stretched. So any declines around to 60 levels is a very good opportunity to get into such a stock. But industry is coming back in shape at home as well as abroad, so we cannot say that things are on the downhill. Things are moving up, and once we have everything going, we may see valuation stretch even further. So still it is down 55% from the all-time high. So at around 80 rupees, it is still down 55% from the all-time high of 130 or so, 150 or so. So you need to understand this. So when uncertainty subsides and the economy has totally opened up and the virus is gone, this industry will really end up doing very well. The dividend payout is very decent, and that is also a positive for the company. If you look at the technicals, then currently it was surging. So till yesterday it was. So by Saturday it was surging. I made this presentation about a week back. The resistance is around 90. It has fallen to 70 levels. I think any more decline, 10% decline from these levels are good buying opportunity. Above 90 we can see even 120, 125 levels. So around 65 to 60 one can get into the stock with a stop loss at 55 if somebody wants to trade, and we could see 80 to 85 again on the stock. So it may have started a long term bull run in which the new highs would be taken out in due course of time, but we don't know when, and it could consolidate between 60 and 80 in the coming months and before breaking out. So take that into consideration as well. So in my opinion, what needs to be done, you can buy at current levels and on dips to around 60. If you have it, then hold it. I think this will perform over 2 3 years. Have a good 2 to 3 year time frame. It should give good handsome returns, but have only 5% holding in such a stock. And remember why I keep saying this, that have 5% or maximum 10% holding, is because that if even if you lose a lot, you'll be able to lose only 10 rupees out of the 100 rupees invested, or say 7 rupees out of the 100 rupees invested, and you can make money on the others. But if you invest big early, then you could be in trouble if the stock completely reverse. What the strategy should be is to invest low early and then buy big if things really get going after 1 or 2 quarters. You can buy at higher levels. Your average price will remain lower, and you'll be able to still make good amount of money with certainty and with the confidence that your average buying level is extremely low. So this is the reason why I keep saying that you need to go ahead and buy less at the starting and increase your holding. I'm not saying keep it at 5%, but increase your holding. If the stock goes up 30 40%, you can buy more, and 100% you can buy further little bit. Your average will remain low. So this is the reason why I feel that you should buy less in the initial stages. So this was my video on JK Tires. Please like and subscribe my channel and hit the bell icon so you can get my videos straight away when I post it, and support me on Patreon. Thanks a lot for watching.